We're generally optimistic about U.S. equity markets as we move through 2025. There's certainly a tremendous amount of uncertainty as we look through the year, particularly with regards to economic policy. But we also know that there's potential for a pretty significant difference between political rhetoric and actual policy that gets implemented. And so during these times of uncertainty, I've found over the course of my career that the best thing to do is to just keep it simple and go back to basics and look at fundamentals. And so when we look at the economy generally in the U.S., what we're seeing is continued evidence that the Fed has managed to successfully engineer a soft landing there. From a labor market perspective, we've seen the jobs market cool pretty significantly from the very heated pace that we saw during the reopening period post-pandemic. But when we look back historically, job growth is actually relatively healthy in that context, and we've seen even some signs of stabilization there over the past several months. As you mentioned, with inflation, kind of a similar story. We've seen inflation levels fall from the very high levels we saw immediately following the reopening and through the major supply disruptions during the pandemic. But pardon me, and although we're still above that 2% target for the Fed, we're steadily moving towards that target, and we think we'll continue to move in that direction, even though the pace of disinflation has slowed a little bit over the past few months. When we look at corporate earnings, what we're actually seeing is analyst expectations reflecting a reacceleration of earnings growth as we move through this year. And so we think that will ultimately translate into better breadth for the markets. And that's really where that importance of having a diversified portfolio comes into play as we sort of transition into this more of a rising tide environment for the market.